Funds that track a market index, such as the S&P 500, are known as index funds. Index funds include both index mutual funds and index exchange-traded funds, or ETFs. These funds typically use a passive investing strategy, which means their objective is to deliver returns similar to an index of investments. However, index funds usually deliver returns that are slightly lower than an index due to fees associated with these funds. In this video, we'll discuss how index funds work, identify some of the indices these funds track, and examine benefits and risks associated with this type of fund. Simply put, index funds are built to have a similar performance to that of a major market index. This means they tend to be diversified in securities across that index and include a number of investments. There are many market indices and index funds that follow them. For example, if you want to invest in U.S. stocks, you might invest in a fund that tracks an index like the S&P 500, which follows the 500 largest stocks in the market, the Dow Jones Industrial Average, which includes 30 large-cap industrial stocks, the Nasdaq 100, which follows 100 large-cap technology stocks, or the Russell 2000, which tracks 2,000 small-cap stocks. For international stocks, an example of a widely tracked index is the MSCI EAFE, which includes large-cap stocks in developed countries across Europe, Australia, and the Far East. For U.S. bonds, an example of a widely tracked index is the Barclays Capital Aggregate Bond Index, which includes a mix of government bonds, mortgage-backed securities, and corporate bonds with different maturities. As you can see in these examples, index funds can track different assets, including stocks and bonds. There are even index funds that follow commodities, currencies, and other assets. But regardless of which type of asset they track, an index fund still has its risks. Put simply, index funds are exposed to the same risks as the index they're following. For instance, if the S&P 500 declines in value, then the index funds which track it will follow suit. An index fund that tracks bonds is at risk if interest rates rise and bonds decline in value. Some investors are willing to accept these risks and choose to invest in index funds because of the potential benefits they might offer. A primary benefit is the typically lower expense ratio, which is the ongoing cost of investing in the fund compared to actively managed funds. As the name implies, actively managed funds use an active investing strategy. This means that they frequently buy and sell investments. This typically results in higher costs or expense ratios and can be a drag on a portfolio's performance over time. Because index funds are passively managed and simply track an index, they generally have a low portfolio turnover, which means they infrequently buy and sell investments. Infrequent buying and selling typically translates into low expense ratios. The low expense ratios of index funds can possibly lead to more growth when compared to the higher expense ratios of similar actively managed funds. Let's look at an example. Suppose an investor purchases $50,000 of two funds that both grow 7% per year before expenses over the next 30 years. The funds are similar in all respects except expense ratio. Fund A is an actively managed fund with an expense ratio of 1.2%. This fund would grow to $271,356. Fund B is an index fund with an expense ratio of 0.2%. This fund would grow to $359,838. That's a difference of $88,482, and it's all thanks to a low expense ratio. The low cost of passively managed index funds can make a difference, and is a reason index funds may outperform actively managed funds over long time periods. This is why some investors take the "if you can't beat 'em, join 'em" approach and use index funds to simply track market indices.
Let me give you a few reasons why this simple index fund investing strategy is so effective. Number one reason is that we can't pick winning stocks. Warren Buffett and Charlie Munger made a profession out of researching and identifying undervalued companies. I think we should check our ego if we think we could pick stocks like Warren Buffett. The harsh truth is that I can't pick winning individual stocks, and neither can you, nor the vast majority of people who claim they did or can. It is amazingly difficult, and having the humility to accept this will be the key to making you rich and wealthy. Index investing is powerful because despite our lack of stock picking skills, we can still amass quite a bit of wealth by harnessing the power of the equities market. When we talk about the stock market, we're most often referring to what is known as the Standard & Poor's 500, or simply the S&P 500. The S&P is an index of the 500 largest companies in the United States. It includes major companies like Apple, Google, and Coca-Cola, and it includes hundreds of other large to small companies. Since 1980, the S&P 500 has delivered an annual average of over 7%. So in order to beat the market, a financial advisor would need to design a portfolio that surpasses this number. This is not easy. The financial advisor must be skilled at designing the right investments, diversifying, and keeping up with market trends. A tall order for anyone. Very few financial advisors have the skill and knowledge necessary to beat an index fund. According to a 2020 Spiva report, over a 15-year period, nearly 90% of actively managed investment funds failed to beat the market. The majority of these actively managed funds had either poor performance and high fees, or average performance and low fees, but only about 1 out of 10 perform well on both fronts. Another reason why index investing is so effective is its low operating cost. Actively managed funds are known to charge anywhere between 1 to 2% expense ratios. This means that between 1 to 2% of your investment is deducted each year to pay the fund manager to run the fund. On a $100,000 portfolio, that comes out to $1,000 to $2,000 annually. By contrast, index funds are much cheaper, given no person is actually managing the fund's performance. The fund simply replicates the index. As a result, most index funds have an expense ratio well under 0.1%. VTSAX and VFIAX, Vanguard's total stock market index funds, and Vanguard's S&P 500 index funds have respective expense ratio of 0.04%. On a $100,000 portfolio, this comes out to $40 annually. I'll take a $40 expense ratio over $2,000 any day. And the real power of low operating costs really comes into play when you incorporate compounding into the formula. These expense ratios can net you or cost you hundreds of thousands of dollars over a period of 10 to 20 years. Costs matter, and the king of low costs are passively managed index funds. Mr. Warren Buffett is worth over $100 billion today. He didn't get there by investing in index funds. He's made some incredible individual stock purchases in his 7 decades of investing. So how shocking was it when in this 2013 letter, he noted that upon his death, the trustees of his wife's inheritance were instructed to put 90% of her money into a very low-fee stock index fund and 10% into short-term government bonds. A simple 2-fund portfolio. And he goes on to say to the rest of us mortals that if we were wise, we would conclude that we do not know enough about specific businesses to predict future earnings. It's a humbling message, but if a man worth $100 billion is sharing his wisdom, I'm willing to listen. However, the next part of the letter bears good news for commoners like me. He says that a typical investor like me doesn't need the stock picking skills. The goal of the non-professional should not be to pick winners. Neither he nor his helpers can do that, but should rather be to own a cross-section of businesses. A low-cost S&P 500 index fund will achieve this goal. Warren Buffett then goes on to recommend the 2-fund portfolio, not just for average individuals investors like you and I, but also an instruction to his trustee. 10% of cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. And I love how he specifically recommends Vanguard. For the specific fund, this would translate to a Vanguard S&P 500 index fund, the VFIAX, and the Vanguard Short-Term Treasury Index Fund, the VSBSX. And he ends his section by saying he believes trust long-term results from this policy will be superior to those attained by most investors. Warren Buffett made his living by picking stocks, one that made him a billionaire today. Yet, following his death, he recommends an index fund strategy, and a simple 2-fund strategy at that. And Warren Buffett isn't the only one that touts this simple 2-fund strategy. One of my favorite authors who wrote The Simple Path to Wealth also recommends a simple 2-fund strategy. His recommendation is slightly different in the specific fund, but the general concept is pretty much the same. He recommends a total market index fund. The Vanguard specific fund will be Vanguard Total Stock Market Index Fund, the VTSAX. And for bonds, he recommends Vanguard Total Bond Market Index Fund, VBTLX. And he breaks down his recommendation by phases in life. When you're in your wealth accumulation phase, when you're still investing into the market, he recommends 100% in stocks, VTSAX. He believes that you should be aggressive in your wealth accumulation phase, and I personally agree. You have time on your side, and because you're in the accumulation phase, the market ups and downs don't matter. And when you're now in the wealth preservation phase, when you're living off your investments, he allocates 75% of his funds to stocks and the rest in bonds and cash. So the question is this. Is a 2-fund portfolio a sound investment approach? Is it something that you and I could follow? And the simple answer is yes.